Chipotle Mexican Grill had a year of stagnation after a very strong run, up about 640% just from 2019 alone. That ended up putting them at a market cap of 47 billion US dollars and a lofty PE of 60. After hours though, the stock is down almost 5% since reporting their Q4 year-ending results. So now it's time to make an analysis so that us value investors can really figure out whether Chipotle is a buy, a sell, or a hold at these levels. So make sure to stick around to the end of the video as we'll answer all your questions and more. How's it going? Welcome to Everything Investing. I hope you're having a great day. As always, we will be analyzing the fundamentals of this business. We'll be using all of that in conjunction with our outlook on this business to use our calculator here to project on the best buying points that are present with Chipotle stock. Finally, we'll conclude off the video with our investment rating. So if you do enjoy these types of videos, make sure to smash that like button. Also make sure to subscribe. They both greatly help out the channel. And don't forget to comment your thoughts on this video down below. Without wasting any further time, let's jump into the analysis. All right, so we're looking at Q4 earnings fiscal year 2022 for Chipotle. What did they report on? Well, they ended up missing analyst expectations by about 60 cents on that bottom line. And that was the main reason we saw the shares decline, because other than that, and the fact that they did miss it by about $30 million worth in revenues, still up on a year-over-year perspective, up 11%. So that's definitely not something to be upset about. And the other important thing that we saw here was that their comparable restaurant sales have increased about 5.6% on a year-over-year basis. This is very important, especially for retail businesses. In restaurant sales also did increase naturally, less lockdowns, more people going out. And we also saw operating margin had an increase there of 380 basis points. So we're seeing some positive signs regardless of that, 5% decrease after hours in the stock price. Now, if we take a look over here at this chart here from Main Street Financial Data, the first link in the description, and an amazing investment resource for us value investors to use, we can see here the number of restaurants that they actually have been increasing over the past few quarters and really years. We can see they've now went from 2.5 thousand stores to over 3,000 stores now. So naturally you're going to see that increase to the revenues on that front, but like we mentioned earlier, you're going to want to see those increases to same store sales. Average restaurant sales naturally in line with that restaurant increase have been increasing as well. Definitely good things to see there. But when we look at this from an income perspective, at least for this quarter, $2.1 billion worth in revenue, on last year's 1.9 million. So an increase there, great to see. But let's actually look at this from a year-ended perspective, considering we have that data available to us. So $8.6 million worth in revenues this year on 7.5 million, over $1 million increase there on that top line. Definitely something investors should be happy about. We account for all of our expenses here, leaves them with $1.1 billion worth in operating income here. We compare that over to last year's results, $804 million. You're seeing that improvement on their margin side as well. We'll talk more about that in just a second. First, let's take a look at the supplemental information, okay? At least for this quarter here, opened up 100 new stores. You can see the improvement on that when you look at that from a historical perspective. No restaurant closures. Average restaurant sales is increasing, and we're still seeing comparable restaurant sales increase as well. Maybe not at the levels that we saw previously, but still growth nonetheless. And so investors shouldn't be concerned at this point. This is the reason why the stock is down though, just because they did miss on their expectations. But we have seen they've been able to control those costs. I know we're in an inflationary period right now, but they're doing a great job of controlling costs. And so it's allowing them to have that margin improvement. Great sign for fundamentals at least. And that's really what's allowing them to have that margin recovery. You can see here from this Main Street chart, not only are gross profit margins increasing, but also operating margin here. So again, despite that 5% decrease in the stock after hours, we're seeing some good signs, right? And I mean, let's look at this from a liquidity perspective. Cash and cash equivalents here, $380 million worth on that balance sheet. We've seen they've been spending a little bit of cash over the last year or so. We'll talk about that more in just a second. But when we look down here at their liabilities, yeah, not much liabilities at all on that balance sheet there. And in fact, no debt. And that's what we're really looking for here. So altogether, a net cash position here of about $380 million worth. We look at this from a free cash flow perspective, cash from operating the business, $1.3 billion worth, in line with last year, but a little bit of an improvement there. They're spending about half of that on, investing and maintaining, sustaining, growing the business, things like that. And so let's just call it about $600 million worth of free cash flows here. What do they do exactly with that $600 million worth of free cash flows? Well, really they're using all their free cash flow and also some cash from the balance sheet to repurchase shares of stock, because it seems like the management team really believes that the stock is undervalued, as they're really ramping up the spending on repurchasing shares down at these current levels. So when we get down here to the annual operating income that we've seen over the last few years, you know, you can kind of see the cyclicality behind this business here. There's going to be bad times. Of course, they did have like an E. coli breakout during this period here, but altogether they have been able to grow now up to $1.1 billion worth in operating income for the year of 2022. You know, a sizable improvement on that $800 million mark last year. You know, so if we get over to our calculator here, and we expect that this business can come in with just about $1.2 billion worth of operating income here. If we require a 10% return, they do not currently pay a dividend, and you know, they're only able to grow at this figure for the next decade, let's say, and they're trading at the same PE they're currently trading at about 59.60. The stock would be fairly valued at these levels right now, and the stock is down to like 1.6k right now. So again, keep that in mind there, as that does just slightly change our metrics. Now, if the business can improve on that and they're able to grow at low double-digit growth for the next 5 years, that drops down to high single-digit growth for the 10 years after that on a 60 PE. The stock would be worth over 2.6 grand, a massive increase from where we are right now. Now, what's really impacting these valuations here is this terminal PE. You know, they do trade at a very lofty PE up at 60. So if for whatever reason that got slashed, starts trading more towards its value, let's just say it starts trading at about a 40 PE. On top of that, they start to see some sales growth of -1% for the first 5 years. Then we see a little bit of that cyclicality in the stock. They start to rebound again with about a 5% growth after that. Again, let's just call it a 45 PE. The stock would only be worth at that point just less than $1,000 per share. So a sizable decline from the current stock levels. Now, if we take a look at some of their competitors here, we can compare that operating income amongst some of their competitors like their Yum Brands, QSR, and let's just throw McDonald's in there as well as a benchmark here. So obviously you're going to see across all the results that we compare, McDonald's is going to outweigh all the rest. But in terms of operating income, McDonald's has about $10 billion worth. Chipotle in comparison only has $1 billion. Yum Brands and QSR Brands, restaurant brands, has about $2 billion worth in operating income. So there definitely needs to be a little bit of an improvement there to catch up to their competitors. Now, in terms of their margins, they're kind of actually at the low end as well in terms of a comparison, but they do use higher quality foods, and so they do have to pay up for that on the back end. So that's kind of something that you have to take into consideration if you do want to invest in this business. You know, part of their business model is to have higher quality foods in terms of fast food restaurants, but obviously you're going to see an impact that on the back end there. Now that leaves us with our market cap comparison here. McDonald's, of course, like we mentioned earlier, it's going to outweigh the rest at $200 billion worth. If we don't compare that, we can look at Yum Brands and QSR. Chipotle definitely has a higher valuation than the other two, even though Yum Brands and QSR have higher levels of profitability. And the last thing I'll do as a comparison here is on the PE side of things. You know, Chipotle up there at about a 60 PE, even McDonald's only half of that. Yum Brands and QSR Brands as well, those are well suppressed from Chipotle's levels up there at 60, which means this business is probably slightly overvalued to a degree at least, and is the reason why I'm only going to give this an investment rating of about a 6. You know, after we've done our industry comparison here, and after we account for our growth projections for Chipotle stock, even with something like a global rebound, I mean, I understand the hype behind the business. They do use quality foods in terms of fast food restaurants, but that to a degree is a bit of a detriment there, just because we've seen how, you know, the lower quality food restaurants are able to have higher margins than something like Chipotle, and ultimately more profits. But at this current point, trading up and around that $1,600 figure, I guess, after hours, I would say this is a medium risk, medium reward type of scenario. That's my thoughts for today's video. If you did enjoy this video to this point, smash that like button. Also make sure to subscribe and leave your thoughts in the comment section below. And with all that out of the way, I'll catch you on the next one.